job market is starting to cool off. That's what today's February unemployment report is expected to show. Economists predict that 100,000 jobs were added to U.S. payrolls last month. That would be the smallest increase in more than 2 years.
Breaking news, the new jobs report shows U.S. employers added only 12,000 new jobs in October. That is much lower than normal. The Bureau of Labor says hurricanes and worker strikes are to blame.
This shows the labor market picked up speed again after those hurricanes and strikes slowed it down the month before.
Big rebound here, obviously, from October when we did have the weather issues. We had a strike at Boeing. We had other issues going on, and they revised October's numbers a little bit higher. But this shows stability in the labor market, 227,000 jobs added. You see that little spike in unemployment?
Yeah.
That's more people potentially looking for work, the way the Labor Department calls up homes and says, are you actually looking for work? Anybody in your home? Little spike there. I wouldn't make too much of it.
The background is that, as I mentioned, the U.S. economy is doing very well. We're in a very good place with the economy. We're growing at, around 2.5%, and inflation has come down. Headline inflation was as high as 7.2 or so. Now it's at 2.3%, and unemployment's at 4.1%, which is a little higher than it was a couple of years ago, but it's still it's a very, very low level. And, we're not quite there on inflation, but we're still making progress. So the backstory is that the U.S. economy is in very good shape, and there's no reason for that not to continue.
Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
2-year note yields went from 190 to 166 in the blink of an eye.
On the NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
Something which looked to be a very solid edifice, and indeed a critical pillar to market competition and free markets, did break down, and I think that, as I said, shocked me. I still do not fully understand why it happened.
A lot of Americans may feel that we've been in a recession for some time, and now, according to the National Bureau for Economic Research, they would be right. That private, not-for-profit group has declared that a recession began in December of 2007.
The issue is that some people have been saying it for a long time. Many economists and experts have been saying that December or January is likely when this recession started. According to the National Bureau of Economic Research, which is the body that officially gets to say it's a recession, December 2007 is when it started. Here's the interesting thing. In November of 2007, our CNN opinion research polls indicated that Americans for the first time felt that the economy was issue number one. And it was the first time that our respondents had said that we were in a recession. More than 50% of respondents said so. In fact, in December of 2007, more than 57% of our respondents to the national poll said that we were in a recession.
Christine, walk us through what we see there and what you're seeing in these exit polls.
I know Tom sees me geeking out over here.
No, it's fascinating.
I love it. It really is. So the condition of the U.S. economy, and remember, these are people who actually voted. I think it's really important to make that distinction again. We've been asking people in opinion polls for 2 years now about how they feel. These are people who actually voted. So this is the clearest view of how people are feeling in the voting booth or when they're filling out their mail-in ballot. So not so good to poor. Look at that number, 67% there. That's a big number. That's the biggest number we've seen in terms of poor and not so good in the last 3 or 4 cycles here. Only 5% say excellent, which is pretty interesting.
And so, no, this is the world we live in. I am always surprised that people are so surprised that we have cycles and things like that. So the real question is what's new and what's different. So I'm going to speak quickly. What's new is there was a housing bubble. The first person, as Warren Buffett says, who was swimming naked out there, you find out who's swimming naked when the tide goes down. The first person swimming naked was subprime. That ended up in CDOs, CIVs, and these insurance companies, and filtered through the markets A, B, C, P. That's the new part, and it's got all these new ramifications. It hasn't quite happened this way. Mistakes were made. What's not new? There's a liquidity crisis. All risky assets reprice. A lot of the problem, even in subprime, was people financing things short that were illiquid assets on balance sheets. So some of these, there's a panic. The markets go down, the R word, recession, takes place. And I mentioned a bunch of these crises. Remember, they didn't all cause recessions. So I know there's a lot of conversation about what this will do, and I'll leave that to the economists. So there are differences, there are obviously similarities. A couple of lessons learned. A lot of assets become illiquid very quickly.
All right. Today is Sunday, December 8th. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Before the financial crisis back in 2009, we had a housing bubble, we had a really hot jobs market, and the experts said nobody saw it coming. Everything was looking okay and up, and then it all went down kaput. But a lot of us did see it coming, and there are early warning signs that you see in the jobs data. And it began in 2007 when the pace of hiring slowed down dramatically. But it wasn't really in the headlines data. It's always you have to peel the onions, you have to look at the details, and you'll see the warning signs. Now, the beauty is the Fed looks at all of that. They don't like to admit it publicly. Of course, the Fed's job is to massage you and give you the nothing to see here, right? Everything is okay. Economy's great. But they know all of these warning signs at a time. And that's why they begin cutting rates. They're not cutting rates out of generosity that, inflation is going down, there is no risk, and we just got to keep cutting rates because, think about it this way. If the economy is pretty good and holding, then why the need to cut rates at all? Just keep rates as they are. It's a bad time to have positive rates in the economy. But of course, they see all of these problems, they begin cutting rates at a time, and we've seen back in 2007 that did not really help a lot. The damage was already done. And we have a lot of warning signs here that the damage has been already done. The Fed will try to cut rates again. Pay attention now. Why would they cut rates if there is no problem with the economy, as Jay Powell been touting all week? But you have to think about the Fed's ability in terms of the ammo of cutting rates if they continue to see those hidden data points continuing to deteriorate. Can they continue to cut rates if we have the inflation enemy coming back? We have a new administration, of course, that could bring a lot of inflation with the tariffs and the protectionist policies. That could limit the Fed's ability to remedy and prevent the problem that we see in the jobs market. Now, you might look at the data that we got on Friday and say, Maverick, what problem are you talking about? I don't see any problem in the jobs market. So let's talk about it right here. We begin right away. The number that we got is 227,000 jobs created in the month of November. The estimate was 220,000, so this is about 7,000 better than expectations, but the unemployment rate went higher from 4.1%, that's the estimate, to 4.2%. Well, gee, how did that happen if we created more jobs than expectations? Well, here it is, the participation rate, this is the share of the population that is working or looking for work, fell to 62.5%, the lowest since May. The rate of workers aged 25 to 54, known as the prime age workers, was little changed. This is the part that explains why the unemployment rate goes higher, but the number is, at least on paper, a beat. Never mind the revisions, of course. We'll talk about that in a minute, but the jobs report is composed of two surveys. While the main payroll number comes from a survey of businesses, the household survey that produces the jobless rate has its own measure of employment. Listen to this, that has fallen by more than 700,000 in the last 2 months, the most since the onset of the pandemic. So the headline reading that they give us, the economy created 227,000 jobs, that's coming from the businesses that they survey. We know that businesses have incentives to show that they're employing folks for taxation reasons. We know that businesses sometimes have to revise things later on. They expect they're going to have a certain number of employees or hires, and then that changes later on. But the household survey, they're just asking regular folks, employees, non-employees. Is anybody in your household looking for work or not? And according to the data, this is the official kitchen data, with the cooking of the data, of course. We have lost 700,000 jobs in the last 2 months alone. Think about that. Continuing, the unemployment rate moved up amid the permanent job losses compared to the temporary layoffs. There were also more people who voluntarily quit as well as joined the labor force but could not immediately find work. It is taking longer for unemployed Americans to find work. The number of people unemployed for at least 27 weeks jumped to the highest in nearly 3 years. So again, folks, you listen to CNBC and the propaganda media, they tell you in face value that, oh, economy is robust, we're creating all of these jobs. But again, that narrative is going to begin to change because we have a change in the administration. So they might actually begin to bring the bad data out and highlight that a little more. But again, you look under the hood of the great headline reading and you see all of this. People unemployed for 27 weeks, the highest in 3 years. We lost 700,000 jobs in the last 2 months. The participation rate is down to 62.5%. And you wonder what the hell is going on. Let me show you something here to what we're seeing in the economy right now. Again, according to the official data. God knows what the non-official data looks like. But when you see the rate of change in labor participation rate ticking below zero and trending down, and then you see the unemployment rate, that is the change in the rate of unemployment, moving higher, you see that split at the end that we're seeing right now. That is an ominous sign. And we've seen that before if we go back to the financial crisis. You can see it that around the summer of 2008, we began seeing the rate of labor force participation trending negatively, while the unemployment rate trending higher. And this is why the Fed is cutting rates. They're not cutting rates out of generosity or because they've defeated inflation. Matter of fact, Jay Powell this week kind of slipped in the interview with, what's his face, Sorkin. He slipped and he said, inflation is doing better than expectations. Oops, then why are you cutting rates again? Well, this is why. He's worried about what he's seeing here. And there's more where that came from. Here's from the Kubisi letter. How do you explain this, they ask. While the non-farm payroll report showed a U.S. added 227,000 jobs in October, other metrics disagree. The household survey showed significant weakness, with the number of employed people falling by 355,000 jobs in November. Meanwhile, the U.S. lost 111 full-time jobs and 268,000 part-time jobs. There are now 1.7 million people in long-term unemployment, up from 1.2 million last year, all while the U.S. government added 33,000 jobs last month alone. Something does not add up here. We know what's going on. You have certain sectors of the economy, healthcare, for example, social assistance, and I know that better than anybody, being in that business right now, where we have an aging population, and we need to serve them. So the shortage of workers there is just going to persist and keep that sector hot. But bear in mind that workers in that sector are now demanding higher and higher wages, and that's inflationary. And then you have the other sector that's creating jobs, which is government. The government spending like a drunken sailor to fluff up and manipulate the numbers, and they're creating all of these hundreds of thousands of jobs for the government for some reason, which is, I think, if we kind of have any department of efficiency, the gimmick by Elon Musk and Ramaswamy. Let's see if they're going to put their money where their mouth is. Because if that efficiency department is for real, we need to see a lot of layoffs in government jobs. And then the third sector in the economy that's producing jobs is leisure and hospitality. And we know why. This is the best economy ever, really. If you're the super rich, you got the Treasury, you got the Federal Reserve, the federal government manipulating stocks higher. So you look at your net worth, your retirement account, and you feel rich, and you begin to spend, and you begin to travel all over the place. So that sector remains hot. But you can see how flimsy this economy really is. Again, the Department of Efficiency can knock out a lot of these jobs created in the government sector. At the moment, we see the stock market suffering a little bit of a hiccup. And that's going to happen because we have the law of large numbers and heavily weighted companies like NVIDIA. You have Apple is just going higher because the VIX is going down and we see passive money coming in via the algorithms. But at the end of the day, they have to face the music. Is the company really selling phones? Or are they selling devices and increasing their services revenue? What about China and all of that? You get just a little bit of a problem in the stock market and you see leisure and hospitality jobs being lost too. And the only sector that remains hot in the economy is the health services for the obvious reasons. But, folks, the trends that we have right now, you got to pay attention to this. The trends that we see right now are negative, and they're eerily similar to what we've seen before the financial crisis in 2009. So you look at the 3 months average in the change of payrolls, the trend is down. We have peaked in 21 and now we're heading down. It's not a bad pace of job creation, by the way, but the trend is down. And when you combine it with other data points, it becomes really alarming. I mean, you look at the revisions that we've seen. These are huge, huge revisions. The biggest since the year 2008. I wonder what happened back then. But this is what the Kubisi letter is talking about. He's talking about, if you look at this chart, the headline reading, we created 227,000 jobs, that's in red. But then you look at the blue column, that's the household survey, and it went negative. And the trend is, it's been negative for a while now. But that's not good news for the economy. Then you look again, the prime age employment to population ratio, the 3-month average. It looks as we are rolling over. We've peaked and we're rolling over. The same look that we've seen prior to the crash in 2009 and the crash in 2020. You look at the hiring rate, it's a negative trend. It's the same thing that we've seen in the onset of the financial crisis. You look at the year-on-year change in jobs gains from a quarterly jobs report, and this is not a good trend. We're heading down. We're trending down, just like we've seen before 2008. Now, perhaps this is really more important than anything because it is the most reliable trend. When you look at the share of U.S. unemployed searching for at least 15 weeks, that's trending higher. And every time we've seen it trending higher, it preceded a recession. Now, we got to remember, we looked at the 3-month average, job creation, the payrolls, that's trending negative. Now, we look at the number of long-term unemployed. What does this trend looks like? It looks like we're trending higher. So again, the headline readings that you read online in the news media or you see it in CNBC and Bloomberg, these headlines are deceiving. Look at the trend that we see in full-time employed. This is a negative trend. And every time we've seen this, we were already in a recession. And that's the point behind this video. You got to remember, I know some of you were too young and you look around you right now and you see no problem. I don't blame you. You haven't seen it before, but you will see it. What we're trying to do here is to prevent you learning the hard way. And this is why discipline, profit-taking, hedging, all of these strategies become really important. But the recession was not officially claimed. We haven't heard it in the news until December 2008. But when they announced that we are in a recession, they said that we were in a recession in 2007. It was just not evident. It didn't show up in the surface because stocks were higher. But we see the same phenomenon right now. The data, the sentiment, the surveys, the polls by the voters, all pointing out that we are already in a recession. But we're not seeing it quite yet because we have a bubble in the stock market. And it is an aggressive bubble, more aggressive than any one that we've seen before. For multiple reasons. We're talking about at least over a decade of easy money policies, and we're talking about trillions and trillions of dollars in stimulus packages, a lot of money in the hands of corporations, a lot of money still in the hand of the consumer, at least a certain segment of the consumer. And it's going to take a lot of time to suck that out. But once it happens, the inevitable takes place, and we look back and say, the economy was actually in a recession since 2023 when the banks began collapsing. We just masked the recession with an AI bubble. And again, the Psalm rule, I know she says, this time is different, but you look at this chart right here. Every time the Psalm rule was triggered, we got a recession. We know that Dr. Sam says all of this because she's a political hack. She didn't want to call out a recession under Biden, but I think right now she's going to restore her sanity because we have a different president and she's going to say, my rule is actually applicable this time around. Now, with all of this happening, all of these are early signs and signals that we are already in a recession. The problem is we go back to the conversation of, you have some recession problems going on in the economy, and the Fed sees it, but we can remedy all of that. The Fed can cut rates and continue to cut rates, and things will ease in time, and all of these recession signals and indicators will be fixed. That's easier said than done because the rebuttal becomes what happens to inflation. The Fed can cut rates if there is no risk of reinflation. But if there is risk of reinflation, then their ability to continue to cut rates will be limited. And on Friday, we got consumer sentiment. Consumer sentiment is going higher. We have a new administration. You see speculative assets going higher. So all of that is a reflection of the sentiment. But we see that every election cycle. Then they take office and we see consumer sentiment coming back down. But look at the 1-year inflation expectations. That actually went higher. That's a warning sign that the Federal Reserve ability to continue to cut rates to remedy this recession that we see in the job data and many other data points will be limited. You look at the Cleveland Fed CPI year-on-year estimate. They actually think that the CPI bottomed and it's going to begin to trend higher. We do have a CPI reading coming out this week, so that's going to be the most important macro data for the week. But if the Cleveland Fed says that, wait a minute, we bottomed, what happens when we have all of the tariffs and all of the trade wars? And oh, by the way, the speculation orgy that we see in financial markets right now, be it in cryptos, be it in stocks, that's going to increase the wealth effect in the economy. And folks will begin to spend more, which will increase the inflation risk even more. And listen to this. This is from San Francisco's Fed Zombie Daily. She says that we are ready to raise rates if inflation breaks out again. Uh-oh, sound the alarm. And I promise you inflation is going to break out again. That's just a matter of time. It's the inevitable. Now, I disagree that they're going to raise rates right away. I think the Fed will be a little bit on the pause side. Okay, we're not going to cut rates, but we're going to pause because they're worried about the inflation or the employment data, rather. And they're going to begin to worry about the inflation data. It's a balancing act. So long as they think that the unemployment risk is higher than the inflation risk, they might switch from cut to pause. But the switch to raise, oh boy, that means that they're shitting their pants. Now they realize that, yeah, the unemployment risk is high, but the inflation risk is higher. That's when you know for sure that it's game over. Sound the alarm. The financial crisis 2.0, the biggest one we've seen ever, begins right away. Now, we just talked about the economy and the macro. Now you know that the jobs number looks good on paper, but you open the hood, we got a lot of problems. Now you look at inflation, early warning signs that we might run into a problem of free inflation as we head to 2025. With understanding that dynamic, what do we do here as stock market investors and traders? How do we position as we head to 25? Because you look at the U.S. stock market, it is the hottest in the world. It is the priciest in the world. The valuation is higher and it diverged from other stock markets around the world, which is quite unusual. But the reason behind that is we lead the AI bubble. We got NVIDIA, we got Microsoft, we got all of the companies that are leading the AI bubble. And this is why we can excuse more multiple expansion here than the rest of the world. Of course, there are certain companies. In the Netherlands, we have the ASML that led to an expansion of valuation. But again, that is limited compared to the magnitude that we have here in the US. And this right here illustrates for you the importance of the weight of AI involved stocks, the heaviest weighted stocks in technology and in the market, their importance in holding the entirety of the market valuation, meaning that if we have any trouble in these names, we're going to begin to trend down. We're not going to excuse these valuations and this divergence anymore. And another worrisome sign besides the extreme valuation is the extreme euphoria that we see. You look at any sentiment indicators, you will see that we've pretty much eliminated any bearish sentiment and we're all in bullish sentiment. And right now there is a good excuse for that. The seasonality is playing out. And part of the seasonality, as we talked about before, if you have an up year, there is little incentive for investors to cash out before the end of the year because you don't want to assume the tax bill. So you're incentivized to hold all the way till next year. On the other hand, there are folks who were staying the sidelines or did not participate as much. They begin to do the end of the year chase. Likewise, if let's say you shorted a stock and you're down in the position, well, this is the time for you to lock in your loss, to take it out of taxes. So it becomes a one-way street of buyers but no sellers unless there's a change in the hierarchy of events where we see seasonality being knocked down and something else taken over. Could it be a bad CPI report? Could it be a geopolitical situation? Could it be a comment by the Trump administration that introduces the policy risk as the top of the hierarchy of events? These are all possibilities. But again, the market does not look good right now, folks, because I know it's going higher, but look at this. Northern Trader says that tech has been rising all week and new SPX highs by extension, while the broader market internals have been negative every day this week. It doesn't mean that we're going to crash tomorrow, but it means that the quality of the pump that we got this week is under question. And we've seen no participation from what should be leading, which is the small caps. If we have a risk-on sentiment, a legitimate one, not just the end of the year chase, then we should be leading by the IWM, the Russell 2000. The Russell did not participate this week. Likewise, if you look at junk bonds or any bond indicator, they did not really confirm the pop that we got in technology stocks this week. But we know why it's happening. one-way street, no sellers. And then you got the end of the year chase. What I want to do is assess the risk in technology, because technology is a broader term. We have chips, we have the big caps, and then we have software. So let's do an assessment of this sector in details and see where the weaker points are, where the stronger points are. And of course, how could we not begin with the most important sector and most important name in the market right now, which is NVIDIA. When we talk about the chips, we're talking about NVIDIA for the most part. This is what led the AI mania. Live and die by the sword. So a lot of you would say, but Maverick, what about AMD? What about Marvell? They showed this and that. I would say at the end of the day, everything will be shadowed by NVIDIA. So we want to know, can we expand the valuation further in 25 or not? When you look at the revenue growth in NVIDIA, it already peaked a couple of quarters ago. It is still producing an impressive rate of growth in revenues that is unmatched by any company right now. But the key in expanding the valuation of stock market is the ability to expand the rate of growth in sales. And in certain stocks, the rate of growth in profits, depending on what we look at. But in a growth story like the AI bubble, we're looking at revenue growth. And that already peaked because there's something called the law of large numbers. And at some point, it becomes harder, if not impossible, to expand the valuation because you cannot expand the revenue growth anymore. Everything is already priced in. What about the big caps, though? What do we see in these revenue or growth trends in the top lines? For the most part, we see them peaking or stalling. So you see Amazon, it peaked, and now it's kind of stalling. It did a little better in the last quarter. You see Meta definitely trending down. You see Google stalling. You see Apple expanding it a little bit, improving a little bit, but it's under 5%. It's not a growth company, really. But because we have an improvement in the rate of growth in revenue, we see the stock is doing a little better. The Microsoft, this one been stalling for a while. So the problem with the big caps is we stall. And we're going to run into the same problem with NVIDIA. It's not as obvious as NVIDIA's problem because the numbers are not as large as NVIDIA's. But keep that in mind because we're going to revisit it in a minute. What about software, though? Software is showing high growth. We're talking about double digits growth. I'm giving you some different names here. So you have the classic old school names like Salesforce. They're not going to produce double digits. Matter of fact, the growth stalled in Salesforce. But you see other names, ServiceNow also trending down, but this is a really impressive rate of growth, 20% plus. You look at Trade Desk, that rate of growth is above 25%. It continues to hold. You got names like Shopify bouncing back in the latest quarter. Names like Datadog continues to perform and giving us a high, exceptionally high rate of growth, and we're not seeing the trends being damaged here at all. So when we do the assessment, let's begin with the chips. What is bullish, what is bearish going into 25? What's bullish is if we see a policy reversal in the chips export ban. Say the Trump administration works out a deal with China and NVIDIA's able to sell tens of billions of dollars worth of chips to China, then sure, that's going to reverse things. Problem is it realistic or not? We also have the stock buybacks. You got NVIDIA with a huge cash position from the bubble. And if they feel that their stock stalled or underperforming, they can deploy some of that cash to artificially fluff up the stock higher. Number 3 is market share expansion. What I mean by that is, suppose AMD begins to eat away some of NVIDIA's market share. Suppose other companies begin to compete in NVIDIA's turf. Then wouldn't these companies deserve expansion in their own valuations? Number 4, the high margins. Companies like NVIDIA still producing huge margins, and if the market focus changes from top-line growth to profit growth, let's say if rates go higher again, it could benefit companies that are actually producing higher margins. And number 5 is the federal funding, so a lot of the expenses are now being taken over by the government. They're spending a lot of taxpayer money to build factories for multi-billion, if not trillion-dollar companies. Whether we agree with that or not, I certainly don't. I think there's a point of national security in all of that. But let the companies build it, and then we'll give them rebates. We'll give them tax cuts. We'll give them incentives. This country is supposed to be capitalist, but it's only capitalist on the population. It is communist when it comes to corporations. In any case, federal funding reduces the burden on companies to build their own factories, and that's a net positive. Problem is, Intel is the biggest benefactor of all of this, and it didn't do a hell of a lot in its stock. The stock is still crashing. On the bearish case, of course, number 1, the export bans, the trade wars, and last time under the Trump presidency, we had a trade war. Chips, semiconductors were the worst performer in the stock market. Why? Because, you look at NVIDIA, you have 3 companies, domestic companies, Meta, Microsoft, Amazon, responsible for over 50% of the revenue. At some point, these companies will have bought enough. of NVIDIA's chips. They'll be done. To continue to expand the margins and the revenue by a company like NVIDIA, we need access to other big players who can buy a lot of chips. That's not going to happen without China. Number 2 in the bearish case for chips is profit taking. A lot of profits made in 24. Some folks might do a risk assessment, some portfolio managers. They decide, you know what, let's book some profits out of NVIDIA. If NVIDIA heads down, that's going to be a problem for the rest of the sector. And that takes us to number 3 and number 4. Why would they take profits out of NVIDIA? The law of large numbers, as I just illustrated for you, it's impossible to expand the rate of revenue growth. In number 4, the concentration in the ETFs by NVIDIA. NVIDIA goes down because of profit taking. It takes everything else down with it. You might see an exception here and there by, Qualcomm went higher, or Intel got a rebound, but for the most part, you'll see chips following NVIDIA. Number 5 is competition and the price power reduction. We talked about the high margins as a positive for NVIDIA because they can charge more, but it costs them less. Why? Because we have an insane demand because of this AI bubble. But what if, say, some of the competitors begin finally produce legitimate competitors to NVIDIA's chips and they price them down? I mean, this is the exact case that happened before, folks. In graphics, in computer processors, in gaming, the earlier adopters enjoyed huge margin incentives. But then in time, companies began to compete and offer better pricing and competitive products. Case in point, Intel with the processors and graphics, and then came AMD. A lot of you don't realize that AMD was a smaller company. It was known for, if you want to buy a cheap computer, you go with an AMD processor because it's a lower quality. That's no longer the case. AMD produces, I would say, superior chips at better prices to Intel. And this is why we see Intel suffering right now. And that will happen at the end of the day with NVIDIA because the competitors will figure it out. And if they do figure it out, then we're going to see price reduction. Now you have more competition. You have more choices as a buyer. And a stock like NVIDIA loses its margin advantage. It contracts in value. It takes everything down with it. What about the big cap technology stocks? Where do we see these guys? In the bullish case, you have the passive investing bubble. I mean, you've seen this week is the greatest illustration. We see hedging being taken out. The VIX goes down because of seasonality. That sends an algorithmic signal to all of the firms with the passive investing to pump more money buying the indices. When they buy the indices, they buy the heaviest weight, and that's going to be Apple, Microsoft, Amazon, and these stocks benefit. Usually, you don't see a reversal in passive investing flows unless you have a change in the macro or change in the Fed policy where the managers become more conservative in their approach of deploying the capital. Number 2 is there is no alternative right now. Is there any alternative in the passive investing bubble? Maybe in the bond market and the fixed income market, rates are becoming competitive again. But you need to see rates heading back to the highs or surpassing the highs to have a new incentive to rotate out of the stock market into fixed income. And that hasn't happened yet. Number 3 is the reliability of growth. These companies have huge power and huge market share and monopolies in certain cases. And absent of an actual recession, they usually produce reliable growth. You don't see big fluctuations or big misses or big reduction in growth. You see them from time to time, but that's the exception, not the rule. Number 4, B2B spending. And we see this happening in the AI mania. With years of ZERP policies and cash being built in these massive mega cap technology companies, they got a lot of cash to spend among each other. If somebody needs services from Amazon Cloud, if somebody needs services from Microsoft, they're going to spend. It doesn't happen what takes place with the consumer because these companies are looking forward. They're looking for an AI age where they have to invest to be prepared for that, regardless of what happens to the economy right now at the moment or what's going to happen in the near term. And so long as these companies begin to spend among each other, you see expansion of revenues, expansion in profits. That's good for expanding the valuation. Number 5 is AI efficiency. If indeed they begin to implement some AI efficiency, we're already seeing some of that in the reduction of headcount. What does that mean? Better margins. If you can produce revenues, even if it is static, if it stalls, and right now I showed you the numbers, the sales growth for big cap companies is stalling for the most part. But you can keep the stock valuation higher if you improve the profitability. You can do that by reducing the headcount. AI helps with a lot of that. What about the bearish case for big caps? High valuations. The valuations are not cheap, folks. And the problem with high valuations is any souring in the sentiment, such as somebody introducing the R word, change in the Federal Reserve policy, change in the White House policy regarding trade and commerce, change in the geopolitics. All of that makes the highest valued stocks in the market as the ATMs to take money out of. Number 2 is the regulatory risk, and we talked about that with the DOJ against Google, and perhaps next Amazon and Meta will be in the crosshairs too. Next thing you know, Microsoft, all of them will be under regulatory risk. Number 3, increased CapEx. So you looked at the trends in revenue, all of them are stalling for the most part. We talked about maybe AI efficiency by reducing the headcount could expand the profits, and that keeps the valuations high in big cap technology stocks. But then the counter to that is, sure, you can reduce the headcount, but can you reduce CapEx? Because whatever you're doing in money saving from reducing headcount, you're spending more in CapEx because we're amidst an AI war. These companies have to spend investment and research to dominate the AI age. That means that the margins are going to stall if not being reduced. Number 4, the cyclical exposure. I mean, think about companies like Apple. The consumer is weaker, they're not going to be buying phones. If we see weakness in the economy, will the advertisers spend on ads in Google or Meta? That's cyclical. Amazon is exposed to the consumer. If the consumer is forced to cut spending because we see the unemployment rate trending higher, that's going to be a net negative for Amazon. And number 5 is the law of large numbers. Again, just like NVIDIA, a lot of these companies expanded their revenue and their profits tremendously in the year 23 and 24. It's going to be really hard to beat these numbers from 24. You need a continuation of the expansion at a higher rate, and we know that the economy is slowing down. So it becomes almost impossible to beat these top and bottom line numbers again. And folks, the expansion of the valuation of any stock, it is dependent on the expansion of the top or the bottom line of the company, depending on what we look at. We appreciate growth, we're looking at the sales. Otherwise, we're looking at the expansion in profits. When you see stocks expanding the valuation with divergence of the trends that we see in the expansion of revenue and profits, usually that doesn't last too long. Usually we see these bubbles happening where we see maybe sentiment, maybe in the case of GameStop, it's just a cultural phenomenon, but we see a spike and then crash right away. So the sustainability in expanding the valuation depends on the expansion of the top and the bottom lines. What about software though? On the bullish case, high, steady growth. We're talking about the highest growth within technology. Outside of NVIDIA, of course, we see double digits in software, and it's been steady. We looked at many companies. Yeah, sure, we see downward trends, just a tick in names like ServiceNow and whatnot, but they're still maintaining high rate of growth. Number 2, a lot of these companies are now becoming profitable for the first time, or they're being brought back to profitability. And we love and appreciate when we have a high rate of growth in revenues, but also expansion and profitability. Those make the best investments, really. Number 3, and perhaps the most important, is the immunity from the trade war. So we know the trade war will impact the chips. We know that the regulatory risk will impact the big caps, but software is immune from both. And this is why it becomes really attractive with the new administration. And number 4, easier implementation of AI. What do we mean by that? If you're a software company, you can implement these AI abilities. Most of them will be efficiency tools right away in your program. But if you think about Amazon, if you think about Google, if you think about Apple, a lot of it is dependent on hardware and really sophisticated software technology that takes longer and longer to perfect. But if you're looking for the implementation of AI efficiency tools, these can happen right away in software and produce actual tangible results, not just promises and hype. There is also no law of large numbers when it comes to software. We're not talking about 50 billion a quarter here like NVIDIA. We're not talking about 30 billion. We're not talking about these massive numbers and expansion that we've seen last year and this year, where it becomes hard for these companies to beat these numbers. And number 6, resilient membership model. A lot of these companies depend on memberships, and you're not going to cancel memberships unless economics change. And this is B2B, so there's a degree of resiliency in the predictability and reliability of the source of revenue. What is the bearish case against software? How about number 1, the risk to higher rates? If we have higher bond yields and the rate goes higher, whatever Daly said, that we might raise rates again. And at that point, we appreciate profitability more than growth, and software doesn't produce a lot of profitability, at least not right now. So these stocks become out of favor. Number 2, the disruption by big caps. These mega cap technology companies are investing a lot of money, and they have spending power that is unmatched by anybody. At some point, whatever tools they develop using AI could make certain software companies obsolete. So the risk of disruption here is huge. Number 3, unlike the chips and big caps, there is no dividend in software. Most names pay no dividend at all. So if we have, let's say, rates going down, and we begin to appreciate dividend investing, and software falls out of favor. Number 4 is the risk-on reputation. What do we mean by that? It means that usually when we think about software stocks, we think about soft landing, risk on, easy money policies, no worries about profitability at all. We only appreciate growth. And you see a little bit of trouble in the Russell 2000, the small caps, companies that produce growth but not a lot of profitability. So if we begin to think about that a little more, and the market begins to appreciate profitability because higher rates or because, let's say, bad news happening in the economy, we will begin to appreciate defensive and risk off rather than risk on. Then that becomes a negative against software. In number 5, we have a low cash positioning here. These companies don't produce a lot of cash because they don't produce a lot of profits. So you're not going to see a lot of M&A. Let's say if there are new AI companies that IPO, can we be excited about AI because of software companies? No, they cannot really afford to do M&A a lot. They cannot afford to do dividends. They cannot afford to do buybacks. And sometimes as the economy begins to get tougher, we appreciate companies based on the generation of free cash flow, which you're not going to see in software. And number 6, in the bearish case, is the technicals are way overextended right now. Let's look at some of these charts. So here's the IGV, the ETF for software. You can see that this one is a little too hot right now at the moment, but it did break out. It looks like it is in a positive trend. And right now, without changing the story at all, the pullbacks will be opportunity to be bought. Now contrast the look at this chart. With this chart right here, the XLK, this is the big caps. It looks okay, it is challenging the highs, but does it look as good as IGV software? No. And then contrast both of them with the third chart right here, the SMH, the chip index. Now this one looks like it's forming a lower high, maybe head and shoulder pattern, about to break the positive trend or the 50 weeks moving average in blue. So the charts, the risk assessment, everything, the logic says that when it comes to the technology sector in 25, software is number 1. The big caps, number 2. They depend on a lot of other external things, among them passive inflows and low volatility and all of that. Number 3, which is probably going to be a short in 25, is chips. They're going to be under all of the risks that we talked about, and I don't think that when you do the risk assessment, the bull versus bear case, it just doesn't bode pretty good for semiconductors. And by the way, who predicted all of this ahead of time? It's probably the guy you're listening to right now. We talked positively about the changes that we see in the technology sector, where the software sector is going to take the leadership. The big caps will still perform, but they're going to fall back in number 2, and chips will fall out of favor. Take a look, which is the IGV software. Now, you look at this weekly chart, looks a lot better than the XLK, and certainly a lot better than the SMH, the chip index. Looking at it from the momentum perspective, if you look at the MACD indicator, are we in a bullish wave? Yes, we are. We're above 0. What about the momentum? It's been bearish for a little while, but now it's kind of changing toward bullish, and it has the potential of accelerating higher. Now, we know that we have the previous high, 69.20 on the chart. That's going to be the burden of proof. If the IGV can close above, then the MACD will certainly accelerate and create new bullish momentum within the bullish wave, perhaps playing the cup and handle pattern that we talked about before. You look at the Vortex indicator. Which one is the predominant momentum right now? The answer is it's the bullish, the blue, not the bearish and red. So right now, when you look at the SMH and back to the XLK versus the IGV, which one looks better? Certainly, without a doubt, it's the IGV. And here's the update for you. If you look at the top that we've seen in technology, in the big cap names or the chip names, NVIDIA to be specific, the July tops. Since that point, you can see in blue IGV software up about 30%. Then you look at the XLK in white, this is big cap technology stocks, up about 9%, not bad, but way lagging software. Then you look at the chips, the SMH, it's been flat, doing nothing at all since the summer. We didn't just talk about the sector, which one to go along with. We talked about the specific individual names within the sector. Take a look. Look at ServiceNow, for example. Weekly chart. The momentum is exploding higher. It is expanding the upper Bollinger Bands higher. You see the MACD indicator under bullish momentum that is accelerating. You see the Vortex indicator, the blue line, is way ahead of the red line, and it's firming up. The RSI is not overbought yet, meaning that ServiceNow is actually supportive of the IGV. We can see ServiceNow gaining while we see Adobe, Oracle pulling back. So now is better than Adobe and Oracle. And again, we can argue that it's a breakout out of a inverse head and shoulder pattern in the weekly. Let's look at a name like TTD, Trade Desk. Again, expanding the upper Bollinger Bands higher. The momentum is predominantly bullish, not bearish. Whether you look at the MACD, whether you look at the Vortex indicator. Way ahead when it comes to bullish versus bearish. The hour size not overbought yet. So this one can print a little more gains before it tops. What about Ohana, CRM, weekly chart? What do we see here? Here we have a tension pattern. We have static highs and we have higher lows. And then we have the MACD indicator. Momentum has been bearish, but maybe it is on the cusp of shifting toward bullish. The hour size firming up. The Vortex indicator gave us a bullish confirmation this week by opening a gap against the bearish momentum in red. So again, you can look at CRM and say, okay, give me a closing above the previous high, 273.23, and then we have a confirmation of a breakout in this name, which we talked about. Datadog looks pretty good here from a technical perspective, but up 6% on what? Earnings were a few days ago. Why is it up 6% right now? I mean, the weekly still look good. You want to chase it. If you want to grab some software, this is still looking pretty good here. And since that video was out, you can see that CRM up about 36%. Then you can see it is followed by Trade Desk, TTD, up about 26%. Then you look at Orange, ServiceNow up about 22% plus. The laggards, Oracle up about 14%, and then Adobe up about 5%. So again, we nailed the sector, and we nailed the specific names. Datadog, we talked about this recently before the breakout. It went from about 125, 130 to now about 170. So, folks, it baffles me when I read some of the comments and all what we get is, oh, Maverick, you've been bearish this, you've been wrong that. Even though I give you a lot of long ideas, day by day, week by week, we cover the market with an honest, open-minded, yet opinionated position. We are in the most dangerous bubble, and the consequence of that will be the most devastating economic crisis. That's the nature of economic cycles. I mean, you go back to the intro of the video with Jamie Dimon. It baffles me that people don't believe in cycles. They happen. And the higher you go in the euphoria, the bigger the contraction. That's the inevitable. But don't say that we don't talk about opportunities day to day, week to week, quarter to quarter. We do that all the time. You're just too lazy and hypocritical, to be honest with you. Because if I have a thumbnail or a video title that is objective, let's talk about stock market sectors for 25. We'll get half of the views. But if I have a thumbnail with Michael Burry, and I say the crash is coming, we get 100,000 viewers right away. At the end of the day, we're YouTubers. We're looking for exposure. But every video has over an hour, almost, of information. You're just too lazy to look. And that's not my problem. And to be honest with you, the negative comments and the criticism, I mean, it doesn't happen from, let's say, the bulls. People who are bullish the market. Because what do they care what others think if things are working their way right now? But they actually appreciate this program and this show because it serves as a devil's advocate, as the counter, the blind spots that you're not seeing. The majority of the complaints that we get happens from what I call the pussy bears, folks who have a bias against the market and against the economy, and I say for good reasons, but they're really good at complaining, yet they have no balls to go long or to go short anything. They're just really good at complaining. And by the way, let's say that we're going to have a crash in February. The market is going to crash in February. I guarantee you, most of them will be caught by surprise and they will not be participants in the crash because they're not prepared. They're just good at complaining and sitting and doing nothing at all. And when they capitulate at the tops. We've seen that happening time and time again in every bubble, in every cycle. And I know for sure, because some of the pussy bears who were with me capitulated in the summer. What did they buy? NVIDIA. NVIDIA been flat since then. You missed the party, buddy. And you're going to miss the action to the upside and the action to the downside because you're only good at complaining, and that's it. I'm happy to have the Mavericks, and that's all I need. I don't need anybody else. And I promise you, we're not going to crash and have the downturn in the market and the economy until every pussy bear capitulates. And the good news is we're seeing a lot of them capitulating right now at the wrong time, at the wrong place. And that leads me to David Rosenberg, which now going to make me look really bad because apologies, Rosie, if you're listening. I'm not calling you a pussy bear. But listen to this tweet here. He says that the remarkable surge in the S&P 500 over the past 2 years has truly surpassed my expectations, especially in the last 12 months. Given that this bull market has persisted long enough, those of us who have found ourselves on the wrong side of the trade must consider adopting a new or different strategy. My latest memo, anyways, the guy's capitulating. Dom Chase, see the comment right there, says this is called capitulation. Classic sign of a bubble when the naysayers join the crowd. Rosie, if you wanted to capitulate, you should have done that with the Wall Streeters. They all capitulated when they realized that they're not going to make money, right? Because the market keeps going higher in a bubble, and they're not going to make money if they stick around to their opinion, even though they're going to be proven right at the end of the day. But they capitulated for understandable reasons. The capitulation should have happened before. But if you do it right now, you're doing it at the end. We just talked about the valuations. We just talked about the economic risk, folks. Really bad time to capitulate right now. When you have a new administration that would serve as the nail in the coffin to the dynamics that we've been seeing in the last 3 to 4 years. But again, to each his own. Last thing I want to finish with here is the morning brief on Friday, because there is a mechanical aspect to the market which is really important for you to understand. On Friday, you can pause this and read it for your own. I'm not going to waste your time, but the bottom line here is on Friday, we got some macro data. It didn't move the market much because it was kind of contradicting each other. So in the beginning, you had a higher unemployment rate. So we've seen rates going down, dollar heading down. Then we got the consumer confidence data, and with it, of course, inflation expectations, which went higher. So we've seen a rebound in both yields and the dollar. Net, it's neutral. So now what happens? Now the market is dictated via the mechanics. An options expiration. And I explained to you again in details that the max pain for the calls in the S&P 500 is 605. If there is a squeeze, and you can see it in the live flow data, folks are buying the calls with the expiration date of that particular Friday, then there is a risk of a squeeze, and that's 610. But we looked at the puts. These are all expiration date Friday. 605 is, again, the point of maximum pain for the calls. If the market maker wants to slaughter the call holders, they move the tape all the way down 605. But we also have a large number of puts. So I said that the sweet spot for the market to go down to is 607. That's going to be the real max pain. And indeed, the low of the day was 607. Now what happened? The 605 calls expired in the money. So somebody is flipping profits if they sell right away on Monday. So don't be surprised if we see 605 being revisited again on Monday's session. That's just the mechanical aspect of the market. Now, lastly, before we wrap it up, we will do the sector analysis, folks, for every sector of the market before the end of the year. So next, I got financials. We're going to look at the big banks, the regional banks, the insurance companies, the asset management companies like Goldman Sachs, BlackRock, Morgan Stanley, just like we've done here with technology. When we looked at the big caps versus the chips versus software, I'll give you my 2 cents. What do I think about the financial sector of the market? Because we have a lot of changes with the shooting of the insurance. It's healthcare insurance. But now we're beginning to question all of these insurance companies and the behavior and the price gouging and all of that, let alone what's going to happen to the big banks and the regional banks and the asset managers in perhaps a tougher year in 25. And then we'll do healthcare, we'll do dividend-paying sectors, we'll do the industrials, we'll do the cyclicals, we'll do a lot more. So if you do like that kind of coverage, kindly join us as a member. This is what we're going to focus on all the way till the end of the year. We'll focus less on the day-to-day activities and the charts and all of that. We'll focus more on the analysis for the sectors and the series that I promised you for the Discord members, though, which is stock battles. Stock battles will be more specific. So I'll give you some of the names in my list. We have one that I finished this weekend, TJ Maxx versus Ross. We're going to have the defense contractors, so Lockheed, Raytheon, Northrop. We're going to have UPS versus FedEx. We're going to have McDonald's versus Domino's Pizza. We're going to have Deckers versus Skechers. We're going to have Delta Airlines versus United. We're going to have the beer/alcohol battle with the Constellation Brands versus Molson Coors. We're going to do the big pharmaceutical battle with Pfizer versus Merck versus Bristol Myers. And then the casino battle, MGM versus Wynn. The big oil battle, Exxon versus Chevron, and many more. You get the point. We're going to finish that before the end of the year. I think you guys are going to appreciate that work more than the day-to-day bullshit and just talking about the charts and all of that. We'll do that too. But in days where we don't find anything important in the market, we'll just concentrate on doing the sector analysis, the stock battles. I think you guys are going to find a lot of benefit on that. So please join us before the end of the year because we're raising the prices in 25. It's going to be a year like 22. All of a sudden you want to hear what I got to say. It's going to cost you a little more. So be grandfathered in right now. And by the way, we'll give you a sample of the stock battles that we've done before. So I'm going to leave a link in the description to what we've done with Ball versus Newell. At the end of the video, I said you got to pick Newell versus Ball. And guess what happened since then? Newell is up about 40%. It's a shitty stock, it's a shitty company, but it went up 40% because it was so cheap. Ball, on the other hand, went down by more than 10%. So there is an actual tangible benefit from doing these stock battle series videos. But with that, folks, let's segue to the conclusion of this video because we've already ran into the hour limit. So I don't want to keep you here for too long. What do we have on the economic calendar this week? We got Monday the 9th, wholesale inventories, Tuesday the 10th, the NFIB Optimism Index for small businesses, and a revision of U.S. productivity. Wednesday, December 11th, the most important day from a macro perspective because we get a fresh rating of the CPI, the inflation data. Then Thursday, December 12th, we get initial jobless claims and the PPI, the Producer Price Index, also important as much as the CPI these days. Friday, December the 13th, we get the Import Price Index. That's also important to the picture of inflation. And then, of course, with all of the data point we're going to get this week, we're going to form a really good picture on what the Fed is going to do in the upcoming week after that. Are they going to cut rates, hold steady? And that's going to move the market. And look, my hunch is we will see another spike in volatility before the end of the year, meaning we'll see a correction before the end of the year. Then you head to 25, the euphoria and the optimism from the new administration wanes, and we begin to digest the reality of the policies of the upcoming administration. On top of that, the incentives to hold stocks because you don't want to sell for tax reasons, that's going to expire too. And I think that we're going to see a really interesting 2025. So buckle up your seatbelts. The year is not over yet. We have plenty more action to come. But this is all I got for you for tonight. Thank you for listening. Thank you for watching. I appreciate and love all of you. If you like the content, please help us out by pressing the like button. Participate in the conversation in the comment section and subscribe to the channel. And better yet, join us as a member here or better yet in Patreon so you're not paying YouTube. But that's a wrap right here, folks. Thank you for listening. Thank you for watching once again. Be talking to you tomorrow. For now, good night.
Ladies, where exactly are we going? Exactly.
Where the rainbow ends.
Where the rainbow ends.
Don't you want to go where the rainbow ends?